Ladies and gentlemen, this modern investing on Pod TV. My name is Sasha Star, and I have a distinguished guest today. It's Dr. Milan Sombrak. Welcome to the show.
Thank you. Thanks for inviting me. Delighted to be here.
Well, my pleasure to have you. And James Ide from Ide Foundation. Welcome to the show, Jim.
Thank you for having me, Sasha.
Always great to have you. And so last chess show that we had a few days ago, it was from the location of the upcoming chess tournament in Collingwood, and we're all looking forward to it. And to help to attend this tournament, I think we have to make some money on the stock market, so it will offset cost of it. And that's what we're busy doing these days. Today is Wednesday, so what's happened on most Wednesdays? Market is up, okay? So a lot of greens, of course. Now, I'd like to make sure that everybody understands they mitigate your standing by eliminating all your reds and keeping and adding to all your greens. Now, if you have red, you must clearly explain, at least to yourself, but better to your family, why you keeping that red in your portfolio. Why is that? What kind of self-inflicting damages that you're doing, and why you're doing that? I have a couple of reds here, but I have pretty good explanation why. Let me take a look at my reds. Okay. I have a little bit of red, nothing significant, on Banco de Chile, which is paying almost 10% dividend. And now remember that I bought that stock on when it was a time for ex-dividend day. And I expected that after ex-dividend, the stock will go down. But I did it on purpose, deciding that I'm going to, again, it's my greediness. I wanted to kind of snap this dividend payment. So stock went down a little bit. Now it's recovering. And I think in the long run, for me, long run, it's about 2-3 months. But again, in this 2-3 months, I think I will do quite well on that stock. It's now recovering. And by the time the ex-dividend next time will come, it will definitely be in green, much earlier. Sorry?
If your stock is paying a 10% dividend, it's a very high dividend, why do you care if it drops? It'll come back up again, won't it?
I just don't think that seeing the red makes my day. I just hate seeing red. That's all. It's psychological. Yeah, I don't pay much attention. I'll tell you another thing is that actually that's a tip that I wanted to share with everybody. There is a company that is one of the major producers of lithium in South America. Chile is the most stable country in that region. And the name of the stock is, just a moment, let me review. It's Sociedad Química Minera de Chile. Its symbol is SQM. I know symbol very well, but the name not so well.
Yes,
I'm not sure that I pronounce it even right, and probably not. But again, this is a remarkable story. They're producing lithium. They went down, formed the base, and now it's on the way up. It's a little bit in red in my position. And on this one, actually, I sold covered calls. And I got very good premiums. And stock is now $77.31, and it's paying 10.5% dividends. And I sold May 19th calls, 80 with a price point of 80, and I got premium $3.50 for each call that I sold. So I'm sort of I'm hedging a little bit my position here. I didn't follow that stock for a long time, and primarily my idea was to buy the dividends play and also selling the protective calls. So this sort of enhances my position. Now, as I said before, so all the stocks regarding earnings report, especially big banks, I have Goldman Sachs performing fabulously well. It went up today again and generating very good profit there. But I'm still holding on to that because I think there is a lot of room to go much farther. It's now $330.91, almost 331. Now $330.95. And their earnings are on April 18th. I expect that stock to be minimum $350, perhaps much higher. And another one is, but my position mostly in this stock. I have also position on JP Morgan, but not as big one as Goldman Sachs. And that stock is doing quite well too. I don't have any hedging on JP Morgan or Goldman Sachs. I do have hedge on ServiceNow. Stock is doing very well. It's up again today. But I sold deep in the money call and just patiently waiting for expiration date, which is April 21st. And again, most of the money on the stock I will make on covered call, not on the stock itself, because now is a highly volatile, very expensive stock. And I was not brave enough possibly to have naked position on that, but I'm very happy. The premiums are fabulous there. So maybe I will roll over these calls into new calls, also deep in the money. So why not? And Milan, how you're doing in this market so far?
Well, I'd like to talk about one of our members who is a retired dentist. And she did something in her fund portfolio, which was doing so well that she decided to switch it entirely into her core portfolio and not have a fund portfolio anymore. And so she's now retired, and she has a portfolio that's worth roughly $700,000. You cannot retire very well on a $700,000 portfolio, but she's doing it. And this is how she's doing it. For instance, they say that we should withdraw 4% annually from our portfolio. 4%, that's a recommended figure. And 4% of $700,000 is $28,000 plus whatever the government gives you. That's not a lot of money to live comfortably. But she's making over $220,000 annually, which, by the way, is a half what she used to earn when she was practicing dentistry, but she was not very good at saving. She was much better at spending. So she can live very nicely on $220,000. And this is what she does. She takes SPY, which represents the American economy as a whole, not stock picking, the American economy as a whole, the strongest economy in the last 200 years. So she buys into that strongest economy. That's what she owns. And then she writes covered calls just out of the money every Monday, expiry date Friday of the same week. When you write just out of the money covered calls, you get the biggest premium income. And now, you know that if you write a covered call expiry date a year or 3 or 5 years from now, the market will be up. But if it's only 1 week away, the market will be up or down about 50-50. That's what happens. So when she gets assigned, now she's in cash, which allows her to write a cash covered put. Again, just in the money, which gives her the biggest premium income. So every week she does that. And doesn't matter which way the market goes. If it goes up and she gets called away, she's in cash. When she is in cash, she buys cash secured puts and goes back and forth like that. And she is generating on a $700,000 portfolio.
Probably she sells close at the money put, not buys. What do you say?
Sell. Sorry, only sell. Yes, sorry. Yeah. She only sells. That's right, only sells. And so she's generating over $200,000 annually on a $700,000 portfolio. So
Bill, and here we go. So the options are not really a death wish, as some people believe. Sometimes they could be very profitable if used.
well, if you narrow down your options selling, only sell options selling in the right way, that's exactly what happens. It's a safe thing to do. Although generally there are so many ways to make major mistakes in options. I mentioned earlier that Orange County in California some years ago went bankrupt, the largest bankruptcy ever up to that point, and many other examples of options involvement causing major stumbles. But if you are just selling and not buying, and as I described, on your underlying security, there's the risk of selling covered calls or selling cash covered puts entirely derives from the security that you own. If that security happens to be the American economy as a whole, the risk is very low. In the short term, yeah, you could lose, but it doesn't matter because it's going to come back. You know that it's not Nortel, it's not Enron. It will come back. Individual stocks very often never come back. Sometimes they're very surprising stocks. In the late 19th century, early 20th century, railroads were what internet stocks are today. They were the darling of the market. And then Pennsylvania Central Railroad went broke in the early 70s, late 60s, surprising everybody. Individual stocks can fail, can stumble. The American economy someday also will, but that is nowhere near in sight. I keep mentioning how empires have a 100% failure rate, but the failure of the American empire is nowhere in sight yet. So everybody wants to be in the American economy. You take a look at how all money goes where it's treated best, and money is going into the American dollar. So this, what I just described, what this investor is doing with a $700,000 portfolio, living very nicely on a very small portfolio. So,
Milan, I want to slow you down a little bit because this is intriguing to me what you're describing. But okay, so I have some money, and I'm going to invest in SPY, and I'm going to do what's my first action with the cash that I have from my portfolio. I buy SPY or I buy options, or what is the first action I would take?
You buy your security, which is SPY, and SPY is the safest security going because it represents it is an exchange traded fund which tracks the S&P 500,
right?
Precisely, and the S&P 500 is made up of the 500 largest stocks on the New York Stock Exchange. That represents the American economy as a whole, generally speaking. And yes,
I buy it an ETF, and I now have shares in that.
That's your underlying security. Yeah, right.
Yeah. And so then you said something about buying a little out of the money and
Selling.
You sell call
slightly out of money calls, slightly out of the money. So if S&P is 400, you sell 405 covered calls.
And that gives you the largest premium income that you can derive from selling any security, just out of the money on a covered call and just in the money for a cash secured put.
Milan, but if you compare this premium to those of NVIDIA, ServiceNow, or I can mention at least 5 stocks with great premiums on options.
Yeah.
You get much more premium, of course, on these individual stocks than on S&P 500.
Well, Sasha, I found out that what you're saying is quite right, except picking the individual stocks that will give you that can accurately and effectively be done for people like me only with hindsight. Most investors trail the market by 40% by picking individual stocks. That's what they do. Wall Street loves them. They want to see you trading actively, which is a losing thing to do. They want to see you picking individual stocks, which is a losing thing to do frequently. And so, yes, you're quite right, Sasha, except I haven't been able to pick individual stocks successfully, except with hindsight.
So we're staying with this idea of what your member has told you she's doing in her retirement. So she's sold covered calls at Sasha's example at 405, and at the end of the week it's at what, 410, say.
There are two scenarios. One, that the options will expire worthless and you keep your position and the premiums that you generated.
And repeat the process, yeah.
Then repeat the process. So now let's see, for this SPY went from 400, say, to 410. So you're selling now for 15 covered calls.
Gotcha.
On Monday. Okay. Now, there comes a week when S&P will go down and you will be assigned. So all S&P will be taken away from you. However, you keep premiums for you are generating first week, second week, maybe third week, or whatever. It's all yours to keep. Now you're assigned, you have no longer S&P, but you have a lot of cash. So what you're doing, instead of buying back S&P, which is not so bad after all, but again, you're taking a risk as always when you're buying something. But instead, you are selling. So let's say you've been assigned. Let's say S&P 500 is 400, trading at 400. You are selling slightly in the money puts, cash covered puts. You have cash by being assigned. So now you're selling. So let's see, 395 put.
Yeah.
Right, Milan?
Yeah, right. Yeah. But interestingly, what we're talking about here is an effective way. But what we haven't mentioned yet is how much time does it take to do that? On a survey that we did of our members, and we have about 300 members in Monday Morning Millionaire, they're spending an average of 15 minutes a week.
Yeah, it doesn't sound time intensive. Yeah.
It's if you're slow. If you're a little bit faster, you can do it in 5 minutes.
Yeah.
Exactly.
That takes into account the time of booting up your computer system.
Absolutely. Yeah. So once you're up and running, 5 minutes, 4 minutes, 3 minutes, 2 minutes, you've done.
Now, it's different. Some people enjoy the act of trading, and it's a good thing to do so long as they do it in a core portfolio, which almost always will not do as well as, in their fund portfolio, which almost always will not do as well as the core portfolio over the long term. In the short term, a fund portfolio can outperform the core portfolio, which only owns SPY, sells covered calls on it. When it gets assigned, then it's in cash. It sells cash secure puts, and you can do that, as you say, in 4 or 5 minutes, and it's not a lot of fun. But people who are still at work don't have the time to manage a portfolio actively. And
you don't have 5 minutes for coffee break? Or
right. It takes a lot more time to manage a portfolio made up of particularly a large number of individual stocks.
Oh, I see. Fund portfolio, you're right. You need much more than 5 minutes or 10 minutes or whatever. Yeah, totally agree with you.
Well, what happens again with this scenario in like 2022 when the S&P just went down for the year? So do you suffer losses in that scenario? And
in that scenario, yes, Jim, you would suffer losses.
And you need a cash reserve, I would assume.
Yeah.
You suffer losses. What the 2020 was? It 2020 was the worst market drop in history. And
short term, March, April, because then it started to recover. But this March and April were brutal, really, because everything, because of the COVID, of course, everything went down big time and so on. And only then it started to recover. I remember actually my trading in 2020. Yes, I took my biggest loss was apparently on Boeing. Because at that time I was on a cruise ship going for 3 weeks to Latin America and so on. It was right before the COVID started. We arrived back on March 2nd and March 5th, and so everything was about to unwind. Now, because of Latin America on a cruise ship, you don't have a lot of opportunities to manage your portfolio. So I decided to take a very, very defensive position. Boeing was one of them, sold deep covered calls. Boeing was at that time trading, say, 450, and I saw that this problem with MAX 7
Yeah.
27 was already mitigated or so on. So I decided, okay, I sold deep in the money 400 covered calls. The stock was trading around 450. So I thought, okay, it's not enough premium for me, but at least it generates some premium, and I don't have to even think about that. Guess what? Boeing went down eventually to $100 a share.
Yeah.
It's recovering now to say something 200 something, right? But at that time, I had to really struggle with Boeing. First of all, I cut my position in half, but even that didn't work out well for me.
People used to say, people used to say, if it ain't Boeing, I ain't going. That changed to, if it is Boeing, I ain't going, when those two MAX 37s crashed. Yeah. And that could have been prevented.
That was horrible. Yeah. And the bad publicity lasted longer than it affected the stock for a long time.
Yeah. So I decided that all the bad publicity, all the problems with MAX 737, I thought that was already in price of stock. So it wouldn't be for that, stock wouldn't be 450, it would be maybe 650. So I decided that 450 is already taking care of all those problems, so it may stay same. It may fall down somewhat, maybe to 400, maybe 350, but not to $100.
Yeah, right.
That was a really tragic, that was my biggest loss in the last several years. It wasn't fun portfolio, and it created a lot of damage. Now, because of that, when stock started to recover, I was fully invested at the time. I made back most of the money that I lost in Boeing. However, I was very cautious, and I was selling covered calls almost on any and every position. So, of course, it limited my profitability for that year. But it was a very scary time with COVID, very uncertain situation. I was suspicious that as stocks are recovering, but still there are thousands of people are dying almost daily because of COVID. So the travel industry will be absolutely done.
Devastating.
And with that, the Boeing airlines and cruise ships and everything, which was true, that was happening, yes. But high-tech stocks, especially big high-tech stocks, they were flourishing. Internet stocks did well. Netflix did spectacularly well because there was nothing else to do. I was watching Netflix movies.
Yes. What do you do today? I watch Netflix.
Yeah, of course. What else? As a matter of fact, yesterday I watched a spectacular documentary on Netflix by the name Winter on Fire.
Winter on Fire.
I recommend everybody to watch it because that's what happened in Ukraine, winter 2013 to 2014. And that explains everything what transpired later on in Ukraine. That explains why Ukrainians are a different nation from Russians. And it's a well-made documentary. And you see millions of people on the streets.
Thank you for mentioning it. Thank you for mentioning it.
Absolutely. I recommend anybody to.
They also did a fabulous, this is off topic, but fabulous job of getting through the winter this time when their power plants were shelled. And I thought it was, and many people thought it was going to be a brutal winter, but they seem to have come through it. Is that an accurate assessment? You're more in tune with that than I am. But did they come through power-wise, energy-wise, went through the rough winter?
Well, don't forget that Ukrainians are very resilient people, and they were able to, in many cases, they were fixing all the damage almost overnight.
I read an article about how resilient they were. Very impressive.
Now, if we are talking about Ukraine, it's very interesting things happened with the leaks from Pentagon about all the secrets and so on. That story is quite terrible, but all concept. Now Ukrainians are saying that they now reevaluate their plans for the counterattack based on the leaks and what exactly transpired and so on. As some analysts believe that these leaks were self-made to confuse Russians about this upcoming counterattack. That's quite possible too. You can dismiss
yes,
it
yes.
entirely. So,
Double cross.
especially there was a hand of Russian trollists, because they completely screwed a report on how many Russians were lost in the last several months. It was diminished 10-1, and at the same time, Ukrainians' losses were exaggerated. So that's obviously tells me about who is behind these leaks.
Oh, they control the press entirely. The press is entirely controlled in the Soviet Union, and so you read what they want you to read, and they manufacture news.
Oh.
Yes, they do. Yes, they do.
Yeah, we have that. We call it Fox Network.
Fox Network. I heard today somewhere that Fox Network is no longer going to invite Trump on their network.
That's a major event, yeah.
Well, it will be soon very difficult to invite him, because you have to bring cameras to jail and do your reportings from jail, and that's major inconvenience, to say the least.
There's a parallel between what's happening in the Ukraine today and what happened in Vietnam. How many American soldiers wanted to be in Vietnam?
Zero.
Not many.
Probably zero.
How many Vietnamese wanted the Americans out of there?
Oh,
Both North and South wanted it. So the same, is it not the same now in Ukraine? How many Russians want to be fighting in the Ukraine?
Mm-hmm.
And how many Ukrainians want them out of there?
Yeah.
And the outcome is liable to be the same, isn't it?
Yeah, agree. Actually, Mark says very interesting thing, that Murdoch got sued by his shareholders. That was in the news today. I missed it, unfortunately.
well, yeah. The anti-Trump thing that's because Murdoch is soured on Trump, and so now the standing order for networks that he owns, like the London Press, and he has strong foothold there. Fox News in the United States, and so Trump will not be welcome there. But Murdoch has, set stage, created the environment where so many people have been damaged, and so many people have believed what their news was reporting. When I say news with the famous finger quotes, because people have then acted what they thought was the news was the truth.
Election was stolen.
Yeah.
And there was no signs of that. Of course, there was always, you could always find a vote here or vote there, but nothing substantial, nothing that would have changed the election outcome. And that was known for a long time. And it was known by Fox News, people reporting it, bringing people on, saying that they had evidence that the election was stolen. And it was all poppycock. And they knew it, and they were still broadcasting it. I always think that's not only just unethical, immoral, but it should be illegal. And so these suits are justly deserved.
Oh, it's a criminal act. 100%.
Oh, there are many examples of what I call legal crime. Legal crime. For example, the power cord that I need for this device, my smartphone, is different for the power cord that I need for my laptop, which is different from the power cord. So there are about 12 different power cords, all legal, but a criminal activity. Imagine if you needed a different power cord for your toaster, and a different one for your floor lamp, and a different one for your desk lamp. That's what we have with our internet devices. Now, in Europe, they have mandated that they reduce it to one only. And that's going to happen here, not soon enough. So, we need regulators. When I was practicing dentistry, I didn't like to see regulators that walk in unannounced to check how your x-ray equipment is working and how your emergency drug kit is working. But we do need them to get legal crime to become illegal.
So that people don't lose money on Silicon Valley Bank, for example, is not being regulated. And also what you're pointing out with the power cord situations, the companies have no interest in doing it themselves. They want to sell you all the apparel that goes with it, everything, covers everything, and they want it to be just them providing it. So they have no incentive at all to standardize. So these types of things need.
Jim, capitalism, free market capitalism has raised more people out of poverty and created more wealth than any other economic system in history. But it does have its dark underside, such as the one that we are describing here, for which we need regulators to control that from happening. Yeah.
Well, I believe in what Marx said was that capitalism sows the seeds of its own destruction, but not for the reasons that he outlined in his book. And because you do need regulators, and you do need otherwise what we saw over and over again was monopolies, and monopolies take over everything, and you can't compete with a monopoly. So small startups were squished. And so when we have to have some regulatory body that says, hey, you can't have a monopoly, and when you get all this power, you must, like what we did in the United States with the AT&T. It had so much control over the phone systems. They broke it up into 6 regional baby bells, and now all of a sudden it was possible to compete with them. And so we saw a lot of creativity unleashed. So unregulated free market capitalism is a bad idea. Free market capitalism is a good idea if well regulated.
Yeah, so nobody would have an unfair advantage and squeeze
you can't squash
all the money. Mm-hmm.
Then it's not a fair game. It's not a fair fight.
Monopolies are illegal and cartels aren't. But cartels are in many ways similar to a monopoly. And sooner or later, they all fall apart. They start cheating on each other.
Right.
But the diamond cartel continues. The Beers has been able to maintain the price of diamonds, which can be manufactured in a laboratory that nobody can tell them apart. They can be manufactured for a small fraction of what diamond costs.
I want credit for this. I'm going to circle back to SQM, because this SQM that Sasha told us about from Chile. The lithium is the background that they own. They control the lithium to distribute.
Yeah, right.
Yeah, and so the price of lithium was there was a lot of fear of it. So the stock price went down because they think China can control the price of lithium, and if you can set the price of something and you can do it. That's tremendous power. But there is, it's an interesting, lithium is, whether or not the batteries will continue to need lithium is an open question. We have people doing tremendous amount of creative work to get us off of the need for lithium. And whether they're successful or not, the possibility should make an investor take, pause and saying, okay, I'm going to invest in this because you do it in the fossil fuel industry because we're not going to wean ourselves off of oil anytime soon. But one technological breakthrough and the need for lithium can be changed.
Well, that's what's happening. There's some very highly qualified people working in large numbers to replace lithium, to develop lower cost batteries. What's standing in the way of all cars being electric is, first of all, the high cost that has to come down. But the other thing is that you'll need a lot of recharging stations.
Yes.
And the costs are high because of the battery cost being high. When that cost is lowered, and the days when a single individual could make a major discovery, like let's say Galileo showed us that a small rock and a large rock fall at the same rate, and a single individual making such an enormous discovery, those days are gone. Now, scientists from all over the world are cooperating. You see papers written by 60, 80 people.
It's really true. It's an amazing time to watch the development, and the rate of change is accelerating. It's not just going in it's like more like a hockey stick.
So lately I've heard about a European company recharging stations, AVGO. And they have operations in North America as well, and so on. And their charging stations allow car to be fully recharged in about 10 minutes time.
Wow.
Yeah, but most of this recharging station you spend half an hour to recharge your
or
car,
more.
fully recharge. I mean, you can
Right.
little bit recharge in 10 minutes perhaps, but how many miles can you drive?
Right.
But fully
Well,
recharge in 10 minutes, that's a game changer.
An interesting development in an Israeli electric car company which failed, but it is something that I don't understand why it isn't been duplicated. What you would do is you would drive up to a station and the battery would be taken out and a new battery put in a matter of minutes, and off you go. And the next time you need you'll run low, you drive up to the next station, they would replace batteries.
The only reason it could fail because of the in enormous capital investment requires to have the stations, to buy the batteries, and then you exchange your used batteries for new batteries.
And
It's
how do you recycle them, the old batteries? And that's a problem that they're working on solving as well.
Yeah, there is one company, I forgot its name, but I will find out. This company that is working on actually deal with this destruction of this used batteries, because that's also will be a big business. What you do with those batteries when it's time. Now, when you recharge them, that's one story. They can work for several years, but there will be a time sooner or later.
Well, we're a little bit off topic here. We're talking about investing. So something interesting this morning's Wall Street Journal pointed this out. Artificial intelligence can compose a symphony. Artificial intelligence can write a book. Artificial intelligence cannot beat the market. Cannot beat the market. It's able to do so many things, but it cannot beat the S&P.
But I must say that a lot of leading investment houses, and Goldman Sachs is number one of them, they're using a lot computerized tradings.
Oh, yes.
They're doing automatically. For example, if futures are down, they're buying futures, selling stocks, and then when the situation changes, they're doing the opposite way. They're extremely fast, quite accurate. Work absolutely automatically without any participation of manpower. And I think this is one of the reasons Goldman Sachs executes in trading so well. And their trading profits are second to none. And it's one of the reasons what I'm waiting for earnings. But again, for me, it's a short-term play. Once earnings will be announced, most likely I will be out, maybe even before the announcement.
Part of the reason why Goldman Sachs is doing so well, because in their meetings, they spend the whole time talking about how to get more money out of your wallet.
They
spend zero time. Sorry, Jim? Sorry?
I said, what can the suckers buy next?
Yeah, exactly. Yeah, they spend their whole time discussing what can the suckers buy next. They don't spend 1 minute figuring out how to help their investors do better. Not 1 minute of their meetings is spent to help you do better. It's entirely devoted on the subject of how to extract more money from your wallet.
Well, I think their goal is to make money for their shareholders, not necessarily outside investors. But their shareholders, yes, they do spend money to figure out, because all the major personnel of Goldman Sachs, they have enormous stock positions in Goldman Sachs, and of course, the better Goldman Sachs is doing, the more they benefit. And their trading profits are such that whatever individual traders, whether they buy stocks or selling stocks, it's immaterial.
You're right about that, Sasha. All companies' major objective is to make money for the shareholders. Even if it's a small mom-and-pop operation, say you run a laundry or a restaurant, you are the only shareholder, but the objective is to make money for the shareholders.
Yeah.
A large company with a huge number of shareholders, same objective.
Yes, but there's a downside to that as well, in that that consists into the quarterly report phenomena. And Sasha, you use it to make money for yourself by studying it and anticipating what's going to happen.
Yep.
But the quarterly report atmosphere means that less spent on research and development and more on short-term reporting good numbers to your shareholders to prevent something like what's happening with Rupert Murdoch and Fox Corp getting sued. And the shareholders have become so aggressive in the last few decades in suing if they don't make money. If you don't make money for them, then there are legal consequences. And you can plan it into your annual budget, and people do, the corporations do. But they obviously would prefer not to spend money on settling lawsuits and just make money for the shareholders. So there's been so much pressure to be short-term oriented, less pressure on thinking for the long term strategically and positioning yourself to take advantage of what's going to happen in the near term, but not in the quarterly near term basis, on a 3 year to 5 year range. And people that are still thinking in the 3 to 5 year range, I think, are the best bets.
But in a company like Goldman Sachs, what could be 3 to 5 years goals, really? I mean, they are oriented to make money. And the quarterly report, that's an indication whether they followed their goal of making money or not. They're successful at their goal or they're not successful in their goals. And this is the measurement of how good they are. Now, 3 to 5 years, if they will be good at each quarter, they will be, believe me, good in 3 and 5 years and longer too. So it's very difficult for a company like Goldman Sachs. I mean,
for a company like Goldman Sachs, I would agree, because what's the research and development for them? They probably don't have.
Keep making money and more money, buy better machines.
But if you're in the pharmaceutical industry, research and development,
that's a different story.
Yes.
The research and development is so important in the pharmaceutical industry. So let's take a look briefly at AstraZeneca. Astra used to be an independent company doing a lot of research, and they've developed local anesthetics, which dentists use every day. A dentist would inject a local anesthetic into a patient more than 100 times a week. And so Astra had a research department which was very effective and very active. Then they, about, a couple of decades ago, got together with AstraZeneca, and now they are putting out patents and protecting what they have. They have more lawyers in their staff than they do researchers. And research and development is taking a secondary role.
Yeah, that's tragic.
And they got involved in a COVID vaccine. They were not the best ones, but in some countries they're quite popular and still. Yeah. But again, I used to own some AstraZeneca even before COVID. They were at, I remember, $21, $22 a share. They're trading now at 67. So, of course, I didn't hold it for so long. I was out at 35. Then I got back at 37, got out at 49. Then I never repurchased.
Let's take another look back into something that we've talked about a lot, is the stock NVIDIA. And, I bought it on the way down, and I bought it, I'll just be frank, at 180. And it went much lower. And then it's now, what is it, such around 260, 270, something like that.
Yeah.
And so, like my buy and hold philosophy, basically I'm looking at capital gains. I want to hold it for at least a year. And I also have to believe in the company. This is, again, in my fund portfolio. And so when it went down from 180 to probably 120, something like that, it went further down, I didn't panic. Your 7% rule would have had me selling it. And
that's great. If you would sell it, say you bought it at 180, let's say you would sell it at, say, 160 roughly, 165, 160 to 65. Let's say you sold it. It went all the way down to 120. You don't buy it back until you see that it starts to recover. So 130, that would be my entry point, to buy back at 130. So in this strategy, you would be much more successful than...
that's the point I was going to. That strategy would have made me more money.
Yes.
My money, the way I did it, I made myself money, and I did it with less stress and without paying that much attention to it, although I did pay attention because I'm just that kind of person.
Yeah, but the rule 7% would eliminate any stress whatsoever.
That's very true. And I want to reinforce that if it's your discipline, follow it.
Yes.
And take the stress out of it.
On NVIDIA, I would increase 7% to 10%, simply because it's more volatile stocks than your average stock. So I would increase it to 10%. And again, once it started to recover, you just buy back. And that's all. And,
so my discipline is to hold it for a year and then check. and see. Of course, I'm checking in between because I'm curious that way. But my idea is I don't want to pay short-term capital gains tax because I'm believing that this is a winner stock pick.
But you actually generate a loss, which helps you in your tax planning.
And so you got me thinking about changing my approach. But I'm just outlining my approach as it currently is to buy something when it's out of favor if it's a good company.
I'm just looking at NVIDIA here, and it's gone up over a year, over 3 years, over 6 years, gone up. It's just gone down the last couple of weeks, last couple of months, which probably represents a buying opportunity.
No, it was about a year ago.
About a year ago is when I noticed.
Out from 220, even north of 220, it went down all the way to 120. So it's a big drop.
That was the drop that I bought in because I was looking at it, just as Milan was saying, as a bargain, as a buying opportunity. There's a good stock that's always been going up, and it's going to go up again, and it's on its way down now. And it's my philosophy that people, once it starts going down, they pile on and they punish stocks beyond what they're deserving to be punished.
But Jim, you see why when the stock is falling down, it's almost self-fulfilling prophecy.
Yes.
You see, what's happened is, let's say there are some people bought at 220. Most of the people, believe it or not, still have stop losses, even if it's in mind or real stop losses, but almost 99% of the people do have stop losses. So once it's 220 and stock went down to say 200, so they're already 10% red flag. Okay, so those people who bought at 220, they're selling at 200.
Yes.
It generates even more down to
Yes.
And so now people who bought at 200, they're selling at 182 or something. And then it generates even further movement. And I'm talking just one individual stock. But when all market does the same thing, then you see the Nasdaq is dropping 30%, Dow Jones 20%, and so on and on and on.
One of the few systems of investing that works all the time is dollar cost averaging, and you are not in favor of dollar cost averaging.
Dollar cost average works for me on the way up, not on the way down. When stock moves up, then I'm doing cost average. So if I bought, let's say, same NVIDIA and 150.
Well, you're talking about momentum trading here, aren't you?
No, it's not, because remember I showed you several times this book, Market Wizards. Most of these highly successful traders, I'm talking about people who are making 1,000% a year, not 7 or 8, not 15 or 20, 1,000% a year. They're all following the cost average on the way up. So if they start to build up a position on a stock or a whole market, it doesn't matter. So you believe that the market or that stock is going higher. You started to build your position, let's say NVIDIA at 150, it went up to 180. You add more because now your average price is only 175. The stock is now trading 190. So, or at 180, you're already ahead of the game. It went down to 200. You add more.
Sasha, I'm going to check out the individual described in that book, because the record shows that if somebody makes more than $1 million in his early 20s, he's got an 80% chance of being broke by his 60s, because these incredible returns that they're getting involve incredible risk taking. Risk and return cannot be separated from each other.
Milan, obviously, by all means, read this book.
Okay.
This book is it's a series of interviews with the highly successful investors, traders, and so on. And they are looking at all spectrum of their life, how they start trading, how much at the beginning they were losing money, most of them, and then they figured out their own way of trading that started to generate profits, and they started to multiply. And of course, most of the interview were taken down with them when they were already in their age of 50.
Is Jesse Livermore in that book?
No, he's not.
Well, Milan, I'll tell you what my thinking is on the phenomenon that you just described, is because when you're in your 20s and you found something that has made you a millionaire, you start to get a big head. You start to think you know everything, and you start to believe in your own publicity. And so then you get riskier.
Yeah. Oh, yeah, that's possible. That's yeah.
Well, I made when I just started to trade, and I didn't know nothing about it, but I was very lucky with one penny stock where I made a lot of money. And instinctively, I understood that I cannot repeat the same thing over and over, because whether I will find similar stock and which will do so well for me, it's a big question mark. Not that it's impossible, but it's a big question. In the meantime, I have to something to do with the money. So, okay, I bought real estate property and so on, but still I had a lot of money that I could invest into something. And I figured out, I started to investigate how this penny stock public companies work, what it consists of, who are the founders of that company, how they benefit in the long run, or so on. And that led me to, first of all, to invest in one public company and become a director of one a couple of years later. And then I started my own public company in about 2 years' time, because I already had some knowledge of infrastructure, some brokers who are specializing in this type of stocks, some shareholders, some directors, or so on. So I was already capable, and nobody taught me how to do it. I had to really do it right from the beginning myself, and I did it more than once. So it's kind of an interesting story. In one way, maybe I'll write a book or some maybe a movie.
Write a book. But Jim, you were saying that people who make $1 million early in life get a swelled head, right? And
Yes.
start thinking more and more of themselves. You
It's
know,
been my experience talking with people like that they don't have the humility that they may have gotten a little bit of luck involved.
if you take a room of 100 people, 200 people, and ask them how many here feel that they are below average drivers, how many hands would go up? But really, in a room of a large number of people, a small percentage would be average, but most would be either above average or below average. Just the way the mathematics of it works.
Bell curve, right?
How many here feel that they're below average drivers? Half the room are below average. Not many hands would go up.
I bet the husbands would all raise their wives' hands for them.
Well, Milan, you have a point here. I'll tell you what's happened. In order for example, like to be a dentist, you have several years of studying, a diploma, and practice, and so on. You have to know so much to be a professional in that field. Some similar thing in engineering or sciences, biology, science, just any area. See, in the stock market, to be a successful investor, it looks like you really don't have to study anything. You don't need diplomas. You don't need anything. All you need a computer, and you have to have reasonable access.
I know of several stock market advisors who did not finish high school. Hello?
Yeah.
Yeah.
Most of these advisors, actually, they have probably, most of them have a trade to be able to attract capital under the management.
Well, that's
so
right.
they're capable and doing quite well.
People will sell you their system, and their system is 100% guaranteed.
Yeah,
Cool.
that's right. Yeah.
It's always going to work.
But I'm getting a lot of all kind of advices through some emails and some information, so on. I don't read them, but once you have email, before you delete, you see the at least
The headline pitch.
headline, and most of headlines these days, the Reckoning is scamming. The market will drop 70%. The banks will all drop of them, or so on and so on. I can't spend my time reading all that, so I just put it in the garbage one after another. I spent actually a lot of time to send all this in the garbage. I have to unsubscribe to them, but I'm always curious why, when the market is going up, there are so many forces trying to make you sell your stocks. So that's a strategy. That's why all these investment houses, they want people to sell their stock. So they will buy it from you and they will benefit from all the way up. So if you subscribe to such services, just keep deleting them. It doesn't make any sense. Absolutely. Gentlemen, I would like to thank you so much for today's
Another
program.
enjoyable.
Yeah, It's most enjoyable. Thank you so much.
Thank
And,
you. For Thank you.
absolutely. And we'll see you next Wednesday, same time, same place.
Thank you.
Great to see you both
Thank you
again.
very much. Have a great week. Bye-bye.
Bye-bye.